Okay, what if I told you that a computer you've never seen, running lines of code you don't even have access to, has actually already decided how rich you're going to become? It sounds a little crazy, right? But today, in this explainer, we're diving into a massive financial revolution that's been happening entirely behind closed doors. We're going to see how the quiet integration of artificial intelligence into banking is literally fundamentally restructuring personal net worth and global economics as we know it.
Look, this isn't some wild sci-fi movie plot. It's our current reality. Every single day, there are these invisible, highly automated systems making millions of critical, totally life-altering banking decisions. The gatekeepers of the American dream? Yeah, they're no longer just human bankers sitting across a fancy mahogany desk from you. They are highly complex, incredibly data-hungry algorithms. These automated ecosystems now dictate the exact trajectory of your financial life. They determine your credit score, they approve or deny your small business loan, they set your mortgage interest rate, they figure out your credit card limits, and they even influence your insurance pricing. And you know what the most startling part is? The vast majority of people have absolutely zero idea this decision process is even happening.
Now, the stakes here are absolutely incredibly high. Rohit Chopra, the director of the Consumer Financial Protection Bureau, recently issued a stark warning about this exact phenomenon. You see, the law actually dictates that every applicant has the right to a specific explanation if their credit application gets denied. But, as we're going to explore, that right gets incredibly murky when a bank uses a highly complex black box algorithm that even its own developers might not fully understand.
Section 1. The Invisible AI Banker. To really understand how we got here, we have to look at how the financial sector evolved to rely so heavily on big data and fintech in the first place. Let's just contrast the old world with the new. Traditionally, you had a human loan officer, right? They'd look at a few standardized metrics, stuff like your income, your localized credit history, and they'd make a judgment call. Today, machine learning models process massive data sets at literal lightning speed. Banks trust these algorithms for sure, mainly because they offer incredible scale and statistical precision, rapidly predicting risk across millions of users in milliseconds. But here's the catch. Removing the human doesn't necessarily remove the bias.
Section 2. Anatomy of algorithmic bias.
So if machines are just doing math, how do they actually learn to discriminate? How does an algorithm that looks totally neutral on the surface produce unequal outcomes without any human intent whatsoever? Well, the absolutely crucial point here is understanding something called a proxy variable. There's this massive misconception in the tech industry known as fairness through unawareness. The idea is basically, hey, if you don't feed an algorithm data about a person's race, gender, or marital status, the AI is legally blind to it and therefore perfectly fair. But that logic is fundamentally flawed. Algorithms are incredibly smart at finding loopholes to reconstruct that missing data.
So what exactly are these loopholes? Well, algorithms aggressively scan your digital footprint. Seemingly innocent data points. We're talking about things like your zip code, your web browsing habits, whether you apply for a loan using a Mac or a PC, or even if your first name happens to be included in your email address, are heavily scrutinized. These behavioral metrics often strongly correlate with demographic categories and income stability.
As detailed in the Cornell Law Review, statisticians can predict creditworthiness based on what they call a massive mishmash of data. But because this data reflects the real world, it imports the real world's historical biases straight into the machine. The algorithm essentially reconstructs prohibited demographic information by analyzing these complex proxies. So it's entirely bypassing anti-discrimination laws without even trying to.
Section 3. Real-world lending controversies. Let's look at what happens when these proxy variables go completely wrong in the real world. A massive 20 times difference. That was the spark of the highly publicized Apple Card controversy a few years back. A prominent tech entrepreneur revealed that he was given a credit limit 20 times higher than his wife. And this was despite the fact that they filed joint tax returns, shared all their bank accounts, and lived in a community property state. Even Steve Wozniak, Apple's co-founder, reported the exact same weird disparity with his own wife. So the New York State Department of Financial Services actually investigated Goldman Sachs, which was the bank underwriting the card, and impartially speaking, their findings were absolutely fascinating. They found zero intentional bias. None. No statutory violations at all. The algorithm was supposedly entirely gender blind, but it had still learned to replicate historical gender wealth disparities through legacy data and proxy variables. This just perfectly highlights how automated underwriting can systematically disadvantage groups even when strictly following the letter of the law. And these disparities, they extend super deep into the housing market too. A stunning recent study out of Lehigh University took 6,000 mortgage applications and ran them through leading large language models. What they found was mind-blowing. To achieve the exact same approval rate as a white applicant, an otherwise identical black applicant would need a credit score approximately 120 points higher. The AI had just learned from historically biased training data and was replicating it seamlessly. 120 points. That's a game changer for anyone trying to buy a house. Section 4. Compounding the wealth gap. Now, you might be thinking, okay, it's just one loan. But these individual algorithmic decisions don't just exist in a vacuum. Over a lifetime, they compound, massively altering macroeconomic destinies. Just consider the current wealth gap. The median net worth for white households is over $284,000, driven largely by a 72% homeownership rate. For black households, it's just $44,000, with a 42% homeownership rate. When an algorithm consistently quotes higher interest rates or denies loans to minority applicants, based on those proxy variables we talked about, it fundamentally restricts their ability to buy homes. This drastically compounds historical inequalities over generations. And on a global macroeconomic scale, advanced economic modeling shows that as AI automation takes over, the economic returns shift heavily. Capital-augmenting AI makes capital owners vastly more efficient, which increases the net share of wealth going to capital at the direct expense of everyday wage earners. In short, if an algorithm denies you business capital or a mortgage today, you are being locked out of the exact asset classes that AI is currently supercharging. You simply cannot divorce the algorithm from history. Back in the 1930s, the government engaged in redlining, literally physically drawing red boundaries on maps to deny mortgages to minority neighborhoods. That created decades of depressed property values and, you guessed it, legacy data. Today, modern AI training models and automated valuation models ingest that exact historical data to determine current market strength and credit risk. So in a very real way, the past is literally programming the future. Section 5. Inside the black box. So a fair question to ask is, why don't regulators just look at the code and fix it? Well, because detecting this bias is incredibly difficult. First of all, these algorithms are fiercely protected as trade secrets by financial institutions. Second, the data transformations are so unbelievably complex, featuring millions of shifting weights and variables, that even the programmers themselves can't always reverse engineer a single decision. This creates a really scary thing called networked discrimination, where you are basically judged by the digital behavior of people you loosely associate with on the internet, making it nearly impossible for a consumer to legally challenge a rejection. But hey, there is hope on the horizon. As detailed in the Cornell Law Review, statisticians are pioneering this really cool concept called anticipatory auditing. Financial institutions don't necessarily have to legally break open their proprietary black box. Instead, they can employ independent auditors to run thousands of hypothetical applicant profiles through the system to basically smoke out discriminatory proxy inputs before they ever affect real consumers. It's like stress testing the AI for fairness. Section 6. Fixing automated financial systems. The banking sector is definitely at a crossroads right now, and there's a massive effort currently underway to rein in these rogue algorithms before they restructure the economy entirely. The roadmap to responsible AI involves 3 key steps. First, banks must proactively acknowledge that legacy data is inherently biased. You can't fix a problem if you don't admit it exists, right? Second, they must invest heavily in explainable AI, or XAI, basically ensuring models can justify their logic in human terms. And third, strict regulation is emerging. The EU AI Act, for example, now officially classifies AI systems used for credit scoring as high risk. That mandates rigorous non-discrimination testing and constant human oversight. We've built an absolutely incredible financial infrastructure powered by astonishing technology. But as we've seen today, this system is quietly operating on historical echoes, turning past inequalities into hard-coded, automated futures. The greatest financial decision affecting your future, whether you can buy a home, start a business, or build generational wealth, may no longer be made by a banker. It may be made by an algorithm you will literally never see. It's definitely time we stop treating these models as infallible math and start demanding real transparency for the algorithms managing our economy. Take a look at your own digital footprint. Check out your own banking apps. The unseen forces are already at work. So I want you to ask yourself, how is AI shaping your financial life right now?